After studying this module, you will be able to learn the concept of segment reporting, evaluate the benefits and cost of segment reporting, know the major regulations on segment reporting around the world, explore the key differences between Accounting Standard 17 in India and IFRS 8 on segment reporting, understand the basis of segmentation of a diversified firm, and recognize the important items to be disclosed in segment reports. The extent of availability of financial and other relevant information of business enterprises to investors, creditors, lenders and other stakeholders significantly determines the efficiency of capital market, the rate of capital formation and the efficient allocation of resources. Adequate and transparent disclosure is likely to have a favorable impact on firm's cost of capital, share price and market value of the firm. Thus, qualitative business reporting stimulates economic growth and development. This module focuses on segment reporting, that is, reporting of segment information. The diversification of business operations creates need for segment aggregate financial information. A diversified enterprise either carries on activities in two or more business lines or operates in different geographical areas which experience varying degrees of risk and growth opportunities. Thus, the proper evaluation of performance, risk-return profile and profitability of a diversified entity necessitates provision of segment-wise information of various products, services, industries and geographical regions. The United States of America mandated disclosure of segment information in the year 1976, while India made it mandatory with effect from 1st April 2001 for specified companies. Segment reporting is a type of financial reporting in which firms make separate information disclosures by identifying reportable operating segments. In simple words, segment reporting refers to reporting of financial information according to business lines or geographical areas in which the enterprise operates. The primary objective of segment reporting is to enable investors and other users of financial statements to properly analyze the environment in which the firm carries out business activities. The segment reports address the information needs of users and enable them to make more comprehensive assessment of firm's performance and to take better informed and rational decisions. They also assist in predicting firm's future cash flows and in determining market value of the firm. The need for segment-wise information arises from the fact that the consolidated financial statements only provide an aggregated view of the financial performance of the enterprise from all the business lines and geographical regions taken together. The lack of information to the investors leads to faulty investment decisions and inefficient allocation of resources. The segment reporting provides detailed information to investors, and that plays an important role in maintaining capital market efficiency. In India, segment reporting is governed by the Accounting Standard 17 or called as AS 17 issued by the Institute of Chartered Accountants of India. This standard is mandatory with effect from 1st April 2004 for enterprises, namely number 1, whose equity or debt securities are listed or in the process of listing, whether in India or outside India. Number 2, banks and financial institutions including cooperative banks. Number 3, insurance companies. Number 4, whose turnover for the immediately preceding accounting period exceeds rupees 50 crores. Number 5, whose borrowings including public deposits exceed rupees 10 crores at any time during the accounting period. 6, holding and subsidiary enterprises of any of the above. The Securities and Exchange Board of India, popularly known as SEBI, also encourages reporting of segment revenue, results and capital employed. Accounting to revised clause 41 of the equity listing agreement, if a company has more than one reportable primary segment as per AS 17 provisions, it is also required to report quarterly, half-yearly and annual segment information in the prescribed format. Let us now discuss the benefits of segment reporting. Many users of financial reports are interested in information about the performance of one particular part of the enterprise rather than the enterprise as a whole. The consolidated financial statements do not address such information needs for the users. Disclosure of segment information provides an insight into how value is being created by the company. It also helps to understand the company's strategy and opportunities and risks faced by the company. The Financial Accounting Standards Board, popularly known as FASB of USA, has issued FAS 131 on disclosures about segment of an enterprise and related information. The FAS 131 states that the objective of segment reporting is to provide information about different types of business activities in which an enterprise engages itself and the different economic environment in which it operates. According to AS 17 issued by the Institute of Chartered Accountants of India, the segment reporting helps users of financial statements A. for better understanding of the performance of the enterprise, B. for better assessment of the risks and returns of the enterprise, and lastly, to make more informed judgments about the enterprise as a whole. The Chartered Financial Analyst Institute also lays emphasis on the importance of segment reporting for financial analysts. It believes that the segment information is fundamental and integral to the process of financial and investment analysis in order to better understand the economic behavior of a diversified enterprise. The information in segment reports has several benefits for the reporting enterprise, internal users and external users of financial reports. Some of these are: number 1, complete, true and fair disclosure. Segment reporting involves disclosure of complete information about the enterprise and all its constituents, resulting in true and fair representation of the operating results and financial position of the enterprise. Number 2, rational decision making and efficient allocation of resources. Segment information enables users to take more informed credit and investment decisions, leading to increase in market efficiency. Number 3, reduction in information asymmetry. Adequate and detailed segment-wise disclosure in segment reports enhances transparency and reliability of financial reports and reduces information asymmetry between company and external users. Number 4, reduction in cost of capital. Segment reporting enables investors to have good quality, comprehensive and disaggregated information about the enterprise. This reduces uncertainty and enhances investors' confidence and thereby reduces cost of capital to the reporting firm. Number 5, equilibrium in market price of shares. Segment-wise disclosure minimizes uncertainties and fluctuations in the securities market, and thus share prices tend to attain equilibrium. Number 6, appropriate valuation of companies. Segmented data enables more accurate predictions and earnings forecasts by financial analysts, resulting in appropriate valuation. 7, better assessment of future prospects and cash flows. Segment reporting enables users to be able to better predict the future performance, profitability and expected cash flows of an organization. 8, identifying profitable and unprofitable segments. For diversified enterprises which operate in different lines of businesses or geographical areas, segment reporting can reveal which areas are profitable and which are unprofitable ventures. Number 9, prevent frauds and manipulations. Increased disclosures about various segments of the enterprise minimizes the chances of occurrences of frauds, errors and manipulations. Various research studies have examined the potential benefits of segment disclosures and have observed that segment disclosure reduces risk and increases market returns of reporting entities. Also, the predictions and forecasts based on segment information are more accurate than those based on aggregated data. However, the aforesaid benefits of segment reporting may not be achieved in the entirety, since companies are not required to provide information on all segments. The companies have been given discretion to identify reportable segments. This causes companies to report on few broad segments only which qualify the limit prescribed under relevant accounting standard and regulations. Thus, there is a need to amend the accounting rules suitably in this regard. Let us now move on to understand the drawbacks of segment reporting. The opponents of the segment reporting argue that disclosure of segment information involves substantial costs for reporting company which may outweigh its potential benefits. The purported costs include two major types of costs: the cost of disaggregating the consolidated data to prepare segment reports and cost in terms of competitive disadvantage. The alleged drawbacks of segment reporting are: number 1, the investors make investment in company as a whole, and thus information about segments is not so relevant for taking investment decisions. Number 2, the segment reports also suffer from inherent limitations of financial accounting. That is, non-financial performance is not disclosed in segment reports. Number 3, the competitors will have access to confidential, proprietary and sensitive information about segment profitability, innovation and probable weaknesses, causing competitive disadvantage to the reporting company. Number 4, segment disclosure adversely affects abnormal profit earned by companies in relatively less competitive segments. Number 5, high risk of takeover bids due to revelation of poorly performing segments. Number 6, companies having wide variation in profitability across segments are more likely to aggregate information and manipulate segment information. However, the results of many studies suggest that any competitive disadvantage borne by companies from disclosing segment information is only limited. For instance, the Infosys Technologies Limited discloses information about various operating segments and still has been able to sustain its leadership in the IT industry. In fact, the management prefers consolidated data over disaggregated data to avoid accountability. The board of directors should constitute a committee which monitors and ensures that the managers disclose all relevant information and comply with the provisions of segment reporting in true letter and spirit. The different accounting standards regulating segment reporting in various parts of the world have been listed in the table. Difference between AS17 of India and IFRS 8. The International Accounting Standards Board IASB issued IFRS 8 operating segments in November 2006, which superseded the IAS 14 segment reporting. IFRS 8 is a principle-based standard which adopts management approach to segment reporting and requires the information contained in internal management reports to chief operating decision maker. It is envisaged that the management approach would reduce the cost of segment reporting, but it might also adversely affect comparability of segment reports. However, the increased usefulness and relevance of segment reports is likely to outweigh the concerns pertaining to its comparability. The key differences between AS 17 and IFRS 8 are: Number 1, AS 17 applies to listed or in process of listing banking, financial, insurance, other companies who qualify specified limit and holding and subsidiary companies of any of the aforementioned companies, whereas IFRS 8 applies to entities whose securities are issued or traded in public market or file or are in the process of filing financial statements with a regulatory body for the purpose of issuing securities in public market. AS 17 identifies business or geographical segments subject to risks and returns that are different from those of other components. whereas under IFRS 8, the concept of operating segments is based on internal management reporting system that prevails under IFRS 8. AS 17 gives precise definition of segment revenue, segment expense, segment result, segment assets, segment liabilities and segment accounting policies, whereas IFRS does not define these terms specifically. AS 17 adopts more rule-based and less principle-based approach. Principle-based and management approaches are followed under IFRS 8. AS 17 requires identification of primary and secondary segments, whereas IFRS 8 does not require identification of primary or secondary segments. As per AS 17, segment reporting is based on accounting policies adopted for preparing the financial segments of the enterprise as a whole, whereas under IFRS 8, the reporting is done based on internal financial reporting. An entity must describe about the way of determining and measuring reportable operating segments. As per AS 17, a segment is reportable if it meets the 10% threshold criteria of revenue or operating results or assets, whereas under IFRS 8, a segment need not have minimum revenues to be disclosed as a segment. If it is being assessed separately by CODM, it has to be reported. No requirement of reporting based on customers is there under AS 17, whereas under IFRS 8, reporting by major customers is required. Let us now move on to understand the basis of segmentation. Broadly, there are two types of segments based on line of business, that is business segment, and geographical region, that is geographical segment in which the enterprise operates. A diversified enterprise can be subdivided into different segments according to various bases of segmentation, some of which are: number 1, industry. Industrial segmentation organizes companies into broad industrial groupings based on similar production processes or similar products or services. For example, agriculture, energy, food and beverages, pharmaceuticals, electronics, telecommunications, apparels, etc. 2. Individual products and services. The individual products and services may also serve as a basis of segmentation. For example, apparels may be disaggregated into shirts, trousers, jeans, t-shirts, nightwear, suits, saris, etc. Number 3. Product lines. This refers to narrow grouping of similar products and services into a product line or line of business. For example, apparel industry may be subdivided into a number of products such as menswear, women's wear, kids wear, etc. Number 4. Geographical areas. As per AS 17, a geographical segment is a distinguishable component of an enterprise that is engaged in providing products or services within a particular economic environment, and that is subject to risks and returns that are different from those of components operating in other economic environments. In simple words, enterprises are segmented on the basis of place, region of operation which may be domestic or foreign. Number 5. Major customer categories or market structure. An enterprise will provide information about its major customers. According to SFAS 131, a group of entities known to a reporting enterprise to be under common control, central government, state government, local government, foreign government, etc., each shall be considered as a single customer. 6. Profit responsibility centers or divisions. A profit center is one whose manager is accountable for both revenues and costs. It is treated as a separate and independent segment of an enterprise. A division may handle variety of products depending on competence of managers. Our last topic of discussion is major items of disclosure in segment reports. The segment reports contain detailed information pertaining to financial performance of a various segments of the enterprise. The major items to be disclosed in the segment reports are: number 1, segment revenue. Segment revenue is aggregate of the relevant portion of sales revenue of the enterprise which is directly or on a reasonable basis attributable to the segment and revenue from transactions with other segments of the enterprise. However, segment revenue does not include extraordinary items, prior period items, interest or dividend income and gains on sales of investments, unless the operations of the segment are primarily of a financial nature. Number 2, segment expense. Segment expense is the aggregate of expenses resulting from operating activities of a segment. For example, cost of sales and other operating expenses, and relevant portion of enterprise expense which can be directly or on a reasonable basis be attributable to the segment. It includes expense pertaining to transaction which other segments of the enterprise, but does not include extraordinary items, prior period items, changes in accounting policies, income tax expense, interest expense, loss on sale of investments, unless the operation of the segment are primarily of a financial nature. Number 3, segment profitability or result. The segment result is the difference between segment revenue and segment expenses. The segment contribution, that is, segment revenue less variable expenses, and segment net profit, that is, contribution less fixed expenses, may also be disclosed in the segment report for better planning, control and decision making. Number 4, segment assets. These are the assets of the enterprise that are directly employed in the operating activities of the segment or can be allocated to the segment on a reasonable basis. Segment assets are determined after deducting relevant allowances and provisions like provision for bad and doubtful debts, provision for depreciation, etc., and does not include deferred tax assets and excess payment of income tax. Number 5, segment liabilities. These are liabilities that arise from the operating activities of a segment and that which are directly either attributable to the segment or can be allocated to the segment on a reasonable basis. Segment liabilities do not include income tax liabilities and deferred tax liabilities. Number 6. Segment cash flows and fund flows. The sources and uses of funds and the amount of cash flows arising from operating, investing and financing activities of a segment should also be disclosed to enable better assessment of liquidity position of the segment. Number 7. Segment accounting policies. These are the accounting policies approved by the enterprise for presenting segment related information in separate or consolidated financial statements. These policies define the criteria for identifying segments, pricing inter-segment transfers and allocating revenue, expenses, assets and liabilities to those segments. Changes in accounting policies adopted for segment reporting that have a material impact on segment information should be disclosed. Number 8. Primary and secondary segment information depending on the dominant source and nature of risks and returns should be reported in respected formats prescribed under accounting standards. Number 9. Reconciliation. An enterprise should reconcile the information disclosed for reportable segments and the aggregated information of the enterprise. Number 10. Inter-segment transfer. The method of pricing inter-segment transfers and any other changes therein should be disclosed in the segment report. Number 11. Extraordinary items. Extraordinary, unusual and infrequent items attributable to the segment should be disclosed in segment report. Let us now summarize what we have discussed in this module. Segment reporting refers to reporting of financial information according to business lines or geographical areas in which the enterprise operates. The need for segment-wise information arises from the fact that consolidated financial statements only provide an aggregated view of the financial performance of the enterprise. Segment reporting helps users of financial statements to better understand the performance of the enterprise, to better assess the risks and returns of the enterprise, and to make more informed judgments about the enterprise as a whole. The alleged costs of segment disclosures include the costs of processing and disaggregating the consolidated data to prepare segment reports and the cost in terms of competitive disadvantage. The results of many studies suggest that the potential benefits of segment disclosure outweigh the alleged costs. Moreover, any competitive disadvantage borne by companies from disclosing segment information is only limited. SSAP 25 of UK, AS 17 of India, SFAS 131 of USA and IFRS 8, which is a global standard, are the major standards which are regulating segment reporting in different parts of the world. IFRS 8 adopts management approach to segment reporting in which operating segments are identified on the basis of internal reports that are regularly reviewed by the CODM for resource allocation and performance assessment. There are several bases for segmentation of diversified enterprise, industry, products and services, product lines, geographical areas, major customer profit centers, etc. The major items to be disclosed in segment reports include segment revenue, expenses, profitability, assets, liabilities, accounting policies, extraordinary items, cash flows, funds flow, etc. The board of directors should constitute an audit committee which monitors and ensures that the managers disclose all relevant information and comply with the provisions of segment reporting in true letter and spirit.